Welcome to Griffonomics. Today we are bringing you a granular investigative report on Smith Wesson, focusing on a massive operational shift that analysts are calling the Tennessee turnaround.
Yeah, it's a completely transformative shift.
It really is. We're going to look closely at how a legacy manufacturer, essentially a company bound for years by unfavorable legislation in Massachusetts, executed a fundamental top-to-bottom transformation to become a lean, Tennessee-based innovation leader.
Exactly. And for you listening, there are really three key mysteries we want to solve today based on their Q3 fiscal 2026 financial reports. First, we need to understand the massive, almost sudden drop in their relocation costs and what that actually does for their free cash flow.
Right, that capital expenditure cliff.
Exactly. Second, we're looking at a highly surprising 34.6% surge in their handgun sales. And that happened during a time when the broader market is actually shrinking. And third, we're going to unpack what Wall Street analysts are calling the NICS decoupling alpha.
Okay, let's unpack this, because why does this matter to you? Well, whether you're looking for deep value investing insights, whether you're fascinated by the brutal mechanics of corporate turnaround strategies, or maybe you're just, wildly curious about how a 170-year-old brand navigates extreme market cyclicality, this deep dive is going to give you a masterclass in all of the above.
It's a perfect case study.
So let's dive right into the engine room, the business model and the segments that are actually driving the revenue right now. In the Q3 fiscal 2026 report, the numbers paint a very clear picture, and it is heavily weighted to one side.
It absolutely is.
Yeah.
Handguns are the undeniable workhorse here. They make up a massive 79% of total revenue.
Wow.
Yeah, which translates to $107.4 million for the quarter. This is being driven by their success across the board with traditional revolvers, their newer polymer pistol lines, and specifically the runaway success of the Bodyguard platform.
Right, so that's the core. And then on the other side of the ledger, you have long guns.
Correct. That segment represents about 14% of revenue, or $19.3 million, featuring things like their 1854 lever action line and their modern sporting rifles.
So the consumer side is heavily tilted toward handguns, but when reading through the sources, there's another segment that seems to be operating under the radar, and it feels highly strategic. What is going on with the professional channel?
That is a critical, growing area for them and one you absolutely need to pay attention to. Just 6 months prior to this earnings report, they launched what they call the Smith Wesson Academy.
Okay.
This represents a major, calculated pivot to focus heavily on law enforcement, the intangibles, the relationship building, and the specific training provided by the Academy. It's led to direct sales and shipments to nearly 1,000 separate federal, state, and local law enforcement agencies just over the past 18 months.
1,000 agencies in 18 months. That is serious momentum, especially because selling to government and law enforcement usually involves an incredibly long sales cycle.
Oh, absolutely.
You're dealing with bureaucratic red tape, testing, complex requests for proposal processes. To land 1,000 agencies, that quickly means the Academy strategy is acting as a massive accelerator.
Precisely. It creates a sticky ecosystem. Once an agency adopts a platform, the switching costs are incredibly high, which secures long-term recurring revenue for parts and maintenance.
But to really understand the financial position they're in right now, we have to talk about the strategic inflection point, the Tennessee turnaround.
The big move.
Right. The company packed up and moved its headquarters and manufacturing base from Springfield, Massachusetts, driven by what management explicitly described as unfavorable legislation in their former home state, all the way to Maryville, Tennessee.
And you really can't overstate what a colossal undertaking that is.
No, moving a 170-year-old manufacturing operation isn't like moving a software startup. You are moving heavy machinery, supply chains, institutional knowledge. We are talking about a $200 million relocation effort.
What's fascinating here is the financial unlock that occurs right at this exact moment in time. With the new Maryville facility now fully open and operational, their capital expenditures, or CapEx, are projected to absolutely plummet.
Dropping off a cliff.
Exactly. They're coming down from these massive one-time relocation highs to just $25 million to $30 million projected for fiscal 2026.
That is a staggering drop. And just so we're totally clear on the mechanics of that, when your capital spending drops that dramatically, But your top-line revenue holds strong. All of that money that was previously being burned on construction and moving trucks suddenly falls straight to the bottom line. It unlocks serious, transformative free cash flow.
It does. And the specific metrics of this Tennessee move are really interesting when you look at the agreements they signed with the state.
Yeah.
They made a $120 million minimum CapEx commitment to the Maryville area, and they committed to an average hourly wage target of $25.97.
Which is a highly competitive manufacturing wage.
It is. And in exchange for that investment and that payroll commitment, they secured a $9 million economic grant from the state of Tennessee, which is tied to creating 750 new full-time jobs.
So they've essentially traded a hostile regulatory environment in Massachusetts for a highly incentivized, welcoming one in Tennessee.
Precisely.
And beyond the operational savings of that move, the timing coincides with a major indicator of overarching brand strength. I'm talking about pricing power. On January 1st, 2026, management successfully implemented a 2% to 3% price hike across the board.
Right, late in the third quarter.
Now, normally when a company hikes prices in this kind of macroeconomic environment where everyday consumers are getting squeezed by inflation and high interest rates, you expect to see demand drop.
You do, but management reported absolutely zero consumer pushback.
None.
None. They raised prices by 3%, and the consumer simply paid it without blinking. That proves the premium demand for the brand right there.
So what does this all mean? When you combine zero consumer pushback on a price hike with the completion of a massive facility move, that has to show up in the Q3 fiscal 2026 financial realities.
It shows up in a very big way. The revenue beat was highly impressive. Total net sales came in at $135.7 million. For context, that represents a 17.1% year-over-year increase.
Wow.
But the margin resilience is where the real story is. When we look at gross margin, it expanded by 210 basis points to reach 26.2%.
Let's translate that for a second. An expansion of 210 basis points means their gross margins improved by over 2%. On hundreds of millions of dollars in revenue, a 2% efficiency gain is massive.
It's huge.
But what I found really interesting in the sources is that this 26.2% margin isn't even the full story, is it?
No, it isn't. I want to specifically point out how impressive that margin expansion is, because it actually absorbed a 160 basis point headwind from tariffs on imported material.
Wait, so they were penalized on imports?
Yes. So despite paying a 1.6% penalty essentially on imported components, their operational efficiencies in Tennessee, their lower promotional costs, and their increased production volume completely masked that tariff penalty and still delivered that 210 basis point margin growth.
That is the definition of operating leverage right there. And when you take surging revenue and expanding resilient margins, you get a radically transformed balance sheet. What are they doing with all this newly unlocked cash?
They are executing aggressive deleveraging. They are taking this cash and rapidly paying down their revolving credit line. They dropped that debt from $90 million down to $75 million by the end of the quarter.
Okay.
And then right after the quarter ended, they paid down another $20 million, bringing that debt down to just $55 million.
That is an incredibly fast debt paydown. But looking at the cash flow statement, the reversal there might be the most dramatic metric of the entire quarter.
I'd agree. They generated $20.5 million in operating cash flow in Q3. If you look at the exact same quarter in the prior year, they actually used $9.8 million in cash.
So that is a $30 million positive swing in cash generation in a single year.
Exactly.
A $30 million swing is absolutely massive for a company of this size. But that begs the question, how are they driving all this top-line growth to fuel that cash generation? That leads us to their product strategy and what analysts are calling the freshness index.
Right, because instead of just resting on their laurels and relying purely on legacy items, Smith Wesson is relentlessly innovating.
And the data on this is striking. In Q3, entirely new products, meaning new SKUs that simply did not exist in the comparable period last year, accounted for a staggering 44% of all handgun shipments.
Let that sink in for a moment for anyone listening. Nearly half of every handgun that went out the door was a brand new product.
That implies an incredibly aggressive research and development cycle. To have 44% of your shipments be brand new means you are heavily investing in R&D and product design during the exact same time you were spending $200 million moving your factory across the country.
Right.
That is a massive capital allocation risk, but it clearly paid off.
It paid off on the top line, too. Those new products represented 38.7% of total net sales. And because these new models, especially the compact and full-size polymer pistols, sit at higher, premium price points, the average selling prices, or ASPs, for handguns actually rose 5.2% to $419.
Here's where it gets really interesting, because this innovation engine is exactly what is driving the NICS decoupling alpha that Wall Street is so obsessed with right now.
Let's define that for the listener real quick.
Yeah.
Adjusted NICS refers to the National Instant Criminal Background Check System.
Hmm.
The firearms industry uses adjusted NICS as the best, most accurate proxy for actual consumer demand at the retail counter.
Right.
They use an adjusted number to remove background checks that are done for things like concealed carry permit renewals, so it isolates the data down to just actual firearm purchases.
So adjusted NICS is basically the pulse of the broader market. If NICS goes up, the market is buying. If NICS goes down, the market is shrinking.
Exactly. And here's the alpha. In Q3, the broader industry demand, according to NICS, actually fell by 2.2%. The overall market is in a contraction. Yet Smith Wesson's handgun unit shipments into the sporting goods channel surged by 28%.
Wait, the broader market shrinks by over 2%, and their shipments explode by 28%.
If we connect this to the bigger picture, the company is effectively decoupling from a declining industry trend. They aren't just riding a macroeconomic wave, they are swimming aggressively against the current and winning.
Stealing market share.
Actively stealing market share from their competitors through that relentless innovation we just talked about. They're purposefully shifting their product mix to those higher-priced, compact, and full-size polymer models that consumers clearly want.
It is the ultimate flex for a manufacturing company to grow while the competitors are shrinking. But, playing devil's advocate here, whenever I see a 28% surge in shipments in a declining macro environment, I have to ask the hard question.
General stuffing.
Exactly. Are they just shoving boxes into warehouses? Because in cyclical industries, inventory can be a complete death trap. You overproduce, shove it onto your distributors with favorable payment terms just to make your quarterly numbers look good, and then you pay for it next year when nobody orders anything.
That is the exact right question to ask, and it brings us to operational velocity. Let's look at internal inventory first. They actually reduced their internal inventory by $14.6 million since the start of fiscal 2026.
Okay, that's a good sign.
Yeah, that represents a $23 million reduction year over year, bringing their internal inventory down to $175.3 million. So they are definitely getting leaner internally.
Okay, so the factory isn't bloated, but what about the distributors? Are they holding the bag?
To answer your question about channel stuffing, we look at the distributor channel health. The distributor channel right now is incredibly clean. Distributors are holding a strict 9 weeks of supply, which is exactly management's stated target.
And because that 9-week supply metric held completely steady despite the massive 28% increase in shipments, it proves the surge wasn't just channel stuffing. It represents real high-velocity consumer demand.
Exactly. The products are flowing from the Tennessee factory through the distributors and immediately selling out at the retail counter. The operational velocity is incredibly healthy.
Now, before we get to the final verdict on the stock and the deep value proposition, we absolutely need to do some risk and litigation forensics, and we need to be very clear with the listener here.
Yes, we do. The following section contains politically charged topics regarding firearms and ongoing litigation. We're remaining absolutely neutral and impartial here.
Right. We are not taking a stance, and we are not endorsing any viewpoints from either side of the political spectrum.
Exactly. Our sole purpose right now is simply reporting the factual legal disclosures contained strictly within the company's SEC Form 10Q source material.
Perfectly stated and crucial to remember. So, looking objectively at those SEC disclosures, we start with Note 8 contingencies. These are the specific legal risks the company is legally obligated to disclose in their financial filings.
Based on the filings, we can categorize these risks into two main buckets. First, you have the mass casualty torts and public nuisance lawsuits. This includes active cases brought by the cities of Gary, Indiana, Buffalo, New York, and Rochester, New York. It also includes claims related to the July 4, 2022 shooting in Highland Park, Illinois.
And the second bucket.
The second category is a stockholder derivative suit filed in Nevada. This suit targets the company's board of directors, alleging breaches of fiduciary duty specifically related to their marketing practices for what the suit defines as AR-15 style rifles.
And how is the company responding?
For both of these categories, the company has explicitly stated in their filings their intent to aggressively defend against these actions, asserting that the claims lack merit.
And alongside those legal contingencies, there is a smaller but notable financial risk flagged over in Note 2 of the 10Q. The company disclosed what they call an immaterial correction of an error.
Right.
It involves a $1.5 million prior period overstatement in general and administrative, or G&A, expenses, which was related to legal accruals.
Now, $1.5 million might seem like a rounding error for a company generating hundreds of millions in revenue, but it serves as a potential signal.
Yeah.
For you listening and tracking the fundamentals of this turnaround, this could be a signal of legacy, ICFR lapses, internal control over financial reporting.
So it's an accounting flag.
It's a small accounting flag, yes, but one that absolutely warrants keeping an eye on to ensure their internal auditing and accounting controls are tightening up post-relocation.
All right, we have covered the massive Tennessee relocation, the surging margins, the innovation decoupling, and the legal risks. Which brings us to the final verdict, the deep value recovery. Because when you synthesize all these different sources, the Wall Street consensus is highly optimistic.
Very optimistic. Analysts have rated the stock a BUY, projecting nearly 39% upside to a $16.06 target price.
And the core thesis driving that aggressive BUI rating comes down to structural versus cyclical analysis.
That's the key. The market at large is misinterpreting a standard cyclical trough for a permanent structural decline. The firearms industry is historically and famously a boom and bust sector.
Right.
Based on the data, we are currently at the bottom of a normal multi-year downturn. But the market is pricing Smith Wesson stock as if its core business is fundamentally permanently broken.
But the granular data we just went through proves the exact opposite. The value proposition here is undeniable when you look at the raw financial mechanics.
Absolutely.
You have a company trading at a normalized free cash flow yield of 9%. You have zero long-term debt on the balance sheet outside of that highly manageable and rapidly shrinking revolving credit line. You have a board of directors that has maintained a 313-cent quarterly dividend, returning capital to shareholders even during a $200 million relocation.
And arguably, most importantly, that massive disruptive headquarters relocation to Tennessee is finally fully in the rearview mirror. The heavy lifting is done. This company is perfectly positioned to weather any remaining volatility in the market.
So to you, the listener, congratulations. You have just navigated a highly complex financial, operational, and logistical turnaround. What we've looked at today isn't just about one specific manufacturing company. This analysis provides a master blueprint for identifying deep value in out-of-favor cyclical sectors.
It really does.
You look for the companies that are ruthlessly cleaning up their balance sheets, maintaining pricing power in a tough economy, and pouring money into innovation when everyone else in their industry is pulling back.
This raises an important question, and it's the final thought I want to leave you with to ponder today, building on everything we've extracted from these sources. If Smith & Wesson is managing to gain market share, if they are successfully raising prices with zero consumer pushback, and if they are generating massive $20 million plus free cash flow at the very bottom of a 5-year industry downtrend, what exactly happens to their operating leverage and cash generation when the macro cycle inevitably turns positive again? Risk defined. Portfolio protected.